Hello dear students, I Professor Agam Dalal on behalf of JK Shah classes welcomes you all. So why this video? This video is all about RTP November 2022 Direct Tax Inter CA. Now see, ICI recently has uploaded all the RTPs of all the subjects, and in that we are discussing direct tax RTP, that is one of the part of taxation RTP. Now let me tell you, this year, for this November 22 attempt, the RTP that they have issued is somewhat of different level. The questions that they have drafted in this RTP is very much different from what they have drafted in the module. Different in the sense, some of the provisions that they have not covered in the module, they have tried to cover in this RTP. Though the provisions are there, we would have discussed in the classrooms also. But then the questions are somewhat little bit new. Many of the students must have seen that RTP and they would have got frustrated, or they would have got somewhat afraid of what is given. They would have not found the answer, and that's why in dilemma. But let me tell you, literally if you know the provision, you will have a path over here. I'm over here to discuss the entire RTP with all the provisions which are covered in this RTP, and will make sure that after this video, this RTP and all the related sums are really becoming easy for you. One more point, you have to be happy because you came across all the difficult sum before the exam, not in the exam. So it's a good time to cherish about. Now, what I have done over here is, obviously we will be discussing entire RTP and we will be solving entire sums and all. But for the MCQs, I have also prepared some notes over here for some easy calculation and all. So for MCQs, we will be having a help by this notes and we will be looking at the answers through these notes. Now let us move to the very first question without wasting your time, because the time is precious as of now. The first case scenario. High Tech Limited, a real estate development company, entered into an agreement with Mr. Sakshar, a resident individual, on 25th June 2019, as per which Mr. Sakshar agrees to transfer a plot of land measuring 12 acres in New Delhi to High Tech Limited. Mr. Sakshar purchased such land on 14th July 17 for 80,50,000. Now understand, there is a section in capital gain chapter 45 clause 5a. Earlier this section was a very silent section, it was not having that importance. But now don't know why ICI have started putting so much focus on this section 45 clause 5a, and that is all about specified agreement with developer. What I said, specified agreement with developer, redevelopment agreement. See, many a time it happens that I have my old house property or I have a plot of land, and a constructor is coming to me, having a contract with me, taking away my property, building an entire new flats, new property on that, giving me some of the cash consideration and some part in the new property. It is an exchange basically. In this example, Mr. Sakshar gave a land to the developer, and what developer is going to give him back? It is written, High Tech Limited has planned to develop a high-rise society of 250 flat on such land, and in consideration of this land, the company will pay a part consideration 1 crore to Mr. Sakshar on the date of agreement and would provide 3 flat in the society as the final settlement. So can I say, here there are two parties, number one Mr. Sakshar and here High Tech Limited. Sakshar will give land to High Tech Limited under a specified agreement referred in section 45 clause 5a, and against that High Tech Limited will give rupees 1 crore cash consideration plus 3 flat in the new society, in the new flat. So the entire provision will be governed by this section. Now over here, when the property is transferred, see, 14th July 2017 is the date when the land was purchased. 14th July 17. However, the plot is given to the constructor on 25th June 2019. 25th June 19, the things are given to the constructor. Now against that, the flats and all the things will be given. The certificate of completion of the society was issued by the authority on 10th August 21. On such date, the stamp duty value of the flat is rupees 2 crore 51 lakh of each flat. Now, the consideration will be paid on 10th August 21. The question arises, As per section 45 clause 5a, whenever a person is entering into specified contract with a constructor, giving the asset to the constructor to the developer against the new asset, capital gain will arise. In which year the transfer took place? Can I say the transfer took place in the year 1920? The transfer took place in the year 1920. So basically the capital gain should be taxable in the year 1920. And it is the case. But this is the case for all other person other than individual and HUF. For individual and HUF, transfer has taken place in the year 1920. However, the consideration is received in the year 21-22. So for individual and HUF, there is a concession in this section. They are not supposed to calculate capital gain in the year of transfer. They are supposed to calculate capital gain in the year in which the consideration is received. In my example 21-22, the year in which certificate of completion is received. What I said, capital gain is taxable in which year? The year in which certificate of completion of that new flat is received. So over here, tell me, transfer took place in which year? 1920. However, it will be taxable in which year? The year in which COC of the new property received. That is which year? 21-22. Is it clear first of all? Yes or no, public? Okay. Now we have to compute capital gain basically. But before we move to that, let us understand what is the very first question that they have asked. Then we'll read the further questions. What would be the tax, if any, required to be deducted by Hi-Tech Limited in respect of agreement entered into with Mr. Saksher? Now again, a brilliant drafting. They have covered so many corners of the act in this one case study, and that is the beauty of this RTP. Now, in TDS, there is a section 194 IC that we have seen in the classroom, 194 IC. If any developer, any constructor is entering into any specified agreement referred in section 45 clause 5a with any resident individual, whatever cash consideration will be paid to that resident person, a TDS at the rate of 10% will be deducted. So here, Hi-Tech Limited has paid rupees 1 crore as a cash consideration. Cash means not only cash, through bank also, monetary consideration. So here Hi-Tech Limited is giving rupees 1 crore to Mr. Saksher as a cash consideration. Then Hi-Tech Limited will deduct 10% TDS. 10% TDS means 1 crore into 10%. Rupees 10 lakh TDS to be deducted while paying this 1 crore to Mr. Saksher. The answer will be A, rupees 10 lakh. So what I have written in this important point, 194 IC, if any specified agreement entered by person under section 45 clause 5a, at the time of paying cash consideration, TDS to be deducted at the rate of 10%. So 1 crore into 10%, 10 lakh rupees of TDS will be deducted. The second question that they have asked, what would be the capital gain in the hands of Mr. Saksher in respect of the agreement entered into with Hi-Tech Limited, and in which year it will be taxable? I just discussed the transfer took place in the year 1920, but it will be taxable in the year for individual HUF. It will be taxable in the year in which certificate of completion of that new flat is received. In this year, 21-22. So obviously answer D is not the option. It is taxable in the year 21-22. But now we have to find out the amount of capital gain. Perfect. First of all, before we start calculating capital gain, let us first decide the capital gain is short term or long term. Now, the capital gain is short term or long term. To decide this, we have to see period of holding. Period of holding means date of acquisition till the date of transfer. Here the date of acquisition is 14th July 17 and the date of transfer is 25th June 2019. 24th July 17 till 25th June 19, that is the date of transfer. Can I say this period is less than 24 months? Less than 24 months. For a land or building, if the period of holding is less than 24 months, the capital gain will be short term or long term? Short term. The capital gain is short term. There will be no indexation. Though in the question they must have given CII. In the question they have given cost inflation index C. But it is just to put you in some confusions. Please ignore this. The capital gain is short term capital gain. Now if it is short term capital gain, the things are very easy. I have to see what is full value of consideration. Minus that I have to deduct cost of acquisition. Balance will be my short term capital gain. Now what is full value of consideration? Now sir, we don't know. Understand, as per section 45 clause 5a, the full value of consideration is whatever is the stamp duty value of the new flat which you have received at a consideration. The stamp duty value on the date on which COC received, certificate of completion of that new flat received, whatever is the stamp duty plus cash consideration. So here, what is the cash consideration that I have received? 1 crore. Plus I have received 3 flats, and the stamp duty value on such date, that is on the date of completion of certificate received, on that date, stamp duty value of each flat is 2 crore 51 lakh. I have received 3 flat, so 2 crore 51 lakh into 3 plus 1 crore, that means my full value of consideration is 8 crore 53 lakh. Yes or no, public? 8 crore 53 lakh. Acha, let me tell you one more thing. This full value of consideration will become cost of acquisition of those 3 flat when you will sell it in the future. So this FVC will become cost for those flats when you will sell in the future. The station rule is applicable. I always say in my lecture, income tax is based on station rule. The station at which the journey of any train has been stopped for income tax, the next journey will start from the same station. We have completed the journey up to 8 crore 53 lakh for these 3 flats. Now for these 3 flats, the cost will become 8 crore 53 lakh for the next station of capital gain. Understanding this? Now what I have to deduct from this? The cost of the land. And the cost of the land, they have given 80 lakh 50,000. Without indexation, I have to deduct 80 lakh 50,000. So the balance will be obviously what? Short term capital gain of rupees 7 crore 72 lakh 50,000. Everything is written in these notes. See, on specified agreement of redevelopment, capital gain will arise. However, it will be taxable in the year in which COC received if the person is individual or rather HUF also. The full value of consideration means stamp duty value on the date of COC plus cash consideration received. And period of holding will be up to which date? The date of transfer. See, transfer has taken place in the year 1920. So period of holding up to the year 1920. Just we are calculating in the year 21-22. And this FVC will become cost for future capital gain. So here period of holding is less than 24 months, means short term. So the capital gain will be 7 crore 72 lakh 50,000. So let's check which option is the most suitable option. 772.50, yes, the answer has to be C. C, okay. Now, up to now whatever we have read, the 2 questions are solved. Now let us read further. Subsequently on 31st August 2021, Mr. Sakshar sold 2 flats in the society to Mr. Kevin. How much flats Mr. Sakshar had? 3. How much he sold? 2. For a consideration of 2 crore 70 lakh each. While the stamp duty value of every flat was 2 crore 98 lakh on the date of transfer of this new flat. Okay. First of all, here Mr. Sakshar is again entering into a contract to sell 2 flats. That means again over here capital gain will arise. Capital gain will arise to Mr. Sakshar on selling of these 2 flats. Now if I want to calculate those capital gain, the period of holding will start from which date? See, those 2 flats, completion certificate received on 10th August 21. So for me that 2 flat, the period of holding will start from 10th August 21. And I sold on 31st August 21. Don't you think so? It is less than a month. Obviously short term. So this capital gain will be short term. Now, I have to first of all need full value of consideration. I need that full value of consideration. At what amount I sold the flats? 2 crore 70 lakh, that is the actual value. But what was the stamp duty value? 2 crore 98 lakh. Can I say my actual value is lesser than stamp duty value? A section will come into the picture, 50C. 50C for seller. 56 subsection 2 clause 10, gift income for buyer. For buyer, let us keep it pending as of now. Let us pick up first of all for the seller. Section 50C says that if you transfer any capital asset at a value lower than stamp duty value, and if the stamp duty value is more than 110% of actual value, then that stamp duty value will become full value of consideration. What it says against, when the stamp duty value is more than 110% of actual value, that stamp duty value will become full value of consideration. Here what is my stamp duty value? 2 crore 98 lakh. What is the actual value? 2 crore 70 lakh. Let's do 110% of actual value. 2 crore 70 lakh plus 10%. It will become 2 crore 97 lakh. My stamp duty value is 2 crore 98 lakh, higher than 110%. And that's why what will be my full value of consideration for every flat? 2 crore 98 lakh. I sold 2 flats, and that's why my full value of consideration will become 5 crore 96 lakhs. Yes or no, public? Now what I have to deduct? Cost of acquisition. But sir, we don't have a cost. I just said the FVC which you took at the time of earlier capital gain will become cost for the new capital gain. However, this full value of consideration belongs to 3 flats. I sold only 2 flats, and that's why proportionate division of cost of acquisition will be done. So 8 crore 53 lakh is the cost for 3 flat. Then how much for 2 flat? Divide by 3 into 2. That will become 56 lakh 86,667. So my short term capital gain will become 2,73,333. This will be my short term capital gain. This will be my short term capital gain. For whom? For Mr. Samarth. But this is with respect to Mr. Samarth. Now think from the viewpoint of Mr. Kevin, who is a purchaser. For Mr. Kevin, now don't you think so? The purchaser has purchased an immovable property at a consideration lower than stamp duty value. So whatever is the discount, whatever is the difference, that should be taxable to the buyer also. But that will be taxable to the buyer under the head income from other sources under section 56 subsection 2 clause 10. So over here, understand what is the stamp duty value? 2 crore 98 lakh. What is the actual value? 2 crore 70 lakh. What is the discount that I have received? 28 lakh. 28 lakh rupees of discount I have received. Now as per that section 56 to 10, this difference is taxable to the buyer only if this exceeds 50,000, which it is exceeding, plus it should also exceed 10% of actual value. Now what is actual value? 2 crore 70 lakh, 10% 27 lakh. Whether the difference is more than 27 lakh? Yes. Here the difference is more than 50,000 plus it is more than 10% of actual value, and hence this 28 lakh rupees per flat, and he has purchased total 2 flat. So 56 lakh rupees will also be taxable to Kevin under which head? IFOS. Under IFOS, 56 lakh rupees will also be taxable. Are you understanding this gravity of this question? One more thing is written. Mr. Kevin has also earned salary income 30 lakh 50,000 for the year. So if I am supposed to calculate his total income, so salary will be 30 lakh 50,000. Yes or no? So in the exam 50,000 standard deduction I will come to deduct. 50,000 standard deduction, 30 lakh rupees I have to deduct, 50,000 standard deduction I have to deduct. The salary will become 30 lakh, and total salary, total income over here will become 86 lakh. Total income will become 86 lakh. Now let me see what next questions they have asked. Determine the capital gain or loss in the hands of Mr. Sakshar in respect of sale of 2 flats to Mr. Kevin. We just found 2733. See over here. Over here 10 problem is there, by the way, because this is 5 crore 96 lakh and this is just 56 just a second, 8 crore 53 lakh, divide by 3 into 2. So this is okay, 5 crore 68. This is 5 crore 68 lakh 66,667, and against that 27 lakh 33,333. This is the answer. I have also written over here how to compute capital gain. See, full value of consideration 2 crore 98 lakh stamp duty into 2 flat 5 crore 96 lakh. Cost of acquisition FVC divided by 3 flat into 2 flat 5 crore 68 lakh 66,667. Short term capital gain is there. FVC 596 minus cost 2733,333 is the capital gain, and hence the answer will be what? D. The answer is D. However, what would be total income of Mr. Kevin for the year 21-22? So we just did an IFOS income first of all. Per flat 28 lakh. So 2 flat 56 lakh. Salary income 30 lakh. Total income 86 lakh. Total income is 86 lakh. The answer is answer number C. But the question has not ended yet. There is one more paragraph also. out of the proceeds received on the sale of land, Mr. Sakshar has purchased a house on 8th September 21 for a consideration of 47 lakh. Shit. Whatever we have calculated as a short-term capital gain, don't we think so it is wrong? On sale of land, we purchased a house property. Exemption of 54F is available, yes or no? Exemption of 54F? No exemption. Because 54, 54F, 54EC available only when the type of capital asset you transferred were long term. Here the type of capital asset which we transferred is short term. That's why whatever house property we have purchased, we will not get any kind of exemption from capital gain. My capital gain will remain as it is. But the point is, I have purchased a house property for rupees 47 lakh for own residence, that means it is SOP. Mr. Sakshar has taken a loan 35 lakh, which is 80% of the stamp duty value. So if I do that, what will be my stamp duty value of the property? It will be somewhat 43 lakh 75,000. I have taken the loan 80%, that means 35 lakh. From SBI for the purchase of such house, sanctioned and disbursed at 12% on 1st July 21. The loan disbursed and sanctioned both on 1st July 21. He does not own any other residential house on the date of sanction of the loan. And assume both of them have not followed optional tax system of 115 BAC, fantastic. But what they are trying to picturize, I have purchased SOP by taking a housing loan. Interest of that will be allowed as a deduction under the head house property. Section 24 clause B. But over here, over and above 24 clause B, one more section is there into the picture. Section 80EEA. Individual housing loan sanctioned from 1920 till 2122 from financial institution. The stamp duty of the house is less than or equal to 45 lakh. He does not own any other house property on the date of the loan. Can I say all the conditions fulfilled? And that's why over here 1,50,000 80EEA is also applicable. A fantastic question. However, first of all, let us identify what is the total interest. The loan is taken 35 lakh. The rate of interest is 12%. The loan is taken in July 21. That means the interest will be 35 lakh into 12% for 9 months. So 9 divided by 12. Total interest will be 3,15,000. From that, the property is a self-occupied property. So the net annual value will be 0. But interest on borrowed capital I can deduct up to which amount? Rupees 2 lakh. For a self-occupied property, interest on borrowed capital deductible under section 24 clause B, rupees 2 lakh. So 2 lakh I will deduct under 24 clause B. Balance 1,15,000 I will deduct under which section? 80EEA. So now let us find out the total income of Mr. Sakshar. So over here, first of all, the capital gain on sale of transfer of land 7 crore 99 wala point. So over here there are two capital gain. One is 7 crore 72 lakh 50,000. Second capital gain in the same year 27 lakh 33,333. So the total capital gain short term 799,83,333. Acha, house property SOP loss rupees 2 lakh. Now loss of house property can be set off against other head also, maximum up to 2 lakh, which I set off over here 2 lakh. Gross total income 797,83,333 minus I will be able to deduct 80EEA, balance 1,15,000 of interest. Total income 7 crore 96 lakh 68,333, which I have to compulsory round off 7 crore 96 68 330. That is the total income. And that is the answer of the fifth question. What will be total income of Mr. Sakshar? So we just found it is what? 796.68. That is option number B. Option number B. Are you understanding this? So beautiful question, but please understand, once you are doing this question in the exam, nothing will be new from this concept. Everything is covered. Then let us move to the very next question. Little bit easy question. Mr. Raj, aged 65 year, resident senior citizen, salaried person. He has taken a life insurance policy on his major son's name on 1st November 2014. The sum assured is rupees 16 lakh. Premium payable is 1,70,000. Now tell me, under life insurance policy, section deduction section 80C, can I get the deduction by paying the premium of the major son? The answer is yes, because over there any children is covered. So whatever premium I am paying for any of the children, the deduction will be available under which section? 80C. However, if the policy is taken on or after 1st April 2013, I will get deduction up to 10% of sum assured. Over here the sum assured value is 16 lakh. 10% will be 1,60,000. So I cannot take deduction of 170, my deduction will be 160. Arey, but this is eligible amount 160. What is the overall limit of section 80C? 1,50,000. So the deduction of 80C will be restricted to 1,50,000 and let us keep it aside as of now. He has also taken a medical policy of 10 lakh for self and wife on 1st November 21. The medical policy is valid for 5 years. He has paid one-time payment of 1,80,000. So what he has done, in the year 21-22 itself, he has paid 1,80,000 premium for 5 years together itself. Now the question arises, if in the single year I am paying premium for so many years together, whether the deduction will be entirely in the year in which premium is paid or it will be apportioned between the years. So the answer has been given by which section? 80D, Mediclaim 80D. It says that medical premium deduction will be available over a tenure of the years, not in the single year. So here 1,80,000 I have to bifurcate. Fine, I will bifurcate. However, in how many years I have to bifurcate? The common answer that may come 5 years, because the policy is of 5 years. But the answer is wrong. Section 80D has clearly said that medical premium has to be bifurcated in number of previous years which are covered under the policy. Number of previous years which are covered under the policy. Then ignore the fraction of the months in that. Here I took the policy on 1st November 21 for 5 years. Tell me the policy will get end on which date? 31st October 2026. Now just think how many previous year this policy covers? 21-22, 22-23, 23-24, 24-25, even 25-26 and even 26-27 also, because 31st October 26. So it covers 26-27 also, though little bit. So 1 year, 2 year, 3 year, 4 year, 5 year and 6 year. This policy cover total 6 years. Then I have to bifurcate the premium of 1,80,000 over a tenure of 6 years by ignoring the month. So over here, what will be the eligible amount of deduction of 80D for the year 21-22? 1,80,000 divided by 6 years, that will be what? 30,000. However, can I say in 80D maximum deduction is 25,000? Wrong, 50,000. The person is a resident senior citizen. If any person is resident senior citizen, the deduction will be rupees 50,000, not rupees 25,000. So over here 80D deduction will be 30,000. See, maximum deduction is 50,000. I have paid 30,000 rupees. So I will get deduction of 30,000 na. So 80C 1,50,000, 80D 30,000. The total deduction will be 1,80,000. The answer has to be D. I have also covered over here 80C 150 and 80D 6 year I have covered. So 30,000, total 1,80,000. Understanding this? Then a beautiful question again. This kind of question again not covered in the module. The first time they have coming up with this question. The concept is covered. We must have discussed in the classroom also. Mr. Karan completed his MBA in April 2021 and joined XYZ Limited from 1st May 21. So in the very first year of his employment he started. 1st May 21 is the joining date. So total 11 months he must have worked. His basic salary is 2,25,000 per month. And he is also paid 12% basic salary as dearness allowance, which is 100% forming part of retirement benefit. Fantastic. Now understand, the basic salary is 2,25,000. I have worked for 11 months. So 11 month basic salary will be 24,75,000. How much dearness allowance I am getting? 12% of basic salary. So as per that my DA will be 2 crore 97 lakh. Now the question says he contributed 11% of his pay that is basic and DA towards recognized provident fund, and the company also contribute the same amount. Now first of all, whatever employee himself contribute in recognized provident fund, that is allowed as a deduction in 80C. However, whatever employer is contributing in this recognized provident fund, that is called as a perquisite, and against this perquisite one exemption is also available, but the exemption is up to 12% of salary. Now here let us first identify that how much they both are contributing to their RPF. So 11% of this basic plus DA. Basic 24,75,000, dearness allowance 2,97,000. Of that total 11% means they are contributing 3,04,920. Both of them is contributing the same amount. Now, how much exemption is given to recognized provident fund? Employer contribution. Exempt up to 12% of salary, and over there the meaning of salary is same, basic plus DA plus commission. That is obviously percentage forming part. And one more thing is there, if total employer contribution in the entire year for RPF, SPF, NPS, superannuation fund, total employer contribution of RPF, NPS and superannuation fund, if it is exceeding 7,50,000, then excess amount is also taxable. Now see over here, this 3,04,920 is at the rate of 11% of salary. So it is neither exceeding 12% of salary, nor it is exceeding 7,50,000 figure also. So as per the both condition, it is lower than 12% of salary, it is lower than 7,50,000 per annum. This employer contribution is totally exempt. This employer contribution is totally exempt. Because it is less than 12%, it is also not exceeding 7,50,000, hence exempt. However, the point is much more beyond this. What they have said, accumulated interest on provident fund as on 31st March 22 is rupees 49,325. You must have studied one thing, that if employer contribution in the year is exceeding 7,50,000, then excess contribution is taxable. Interest on that excess contribution is also taxable. For that one rule is the rule 3B, in that all the calculation formulas are given. But here as we can see that employer has not contributed more than 7,50,000. So interest belonging to that excess contribution is also not taxable. Then why the point is given? Because of one more point that was effective from 21-22 regarding employees contribution. See, the limit which they have given for employer contribution is 7,50,000. The limit which they have given for employee contribution is 2,50,000. That if in any year employee contribute more than 2,50,000 in RPF, whatever is the interest on that excess amount, that interest will be taxable. See, generally what happens, interest on RPF is exempt if it is at the rate of 9.5%, if it is up to 9.5%. Over here interest amount is only 49,325, so we can clearly identify that it is less than 9.5% only, because the total amount which we have invested is huge amount and this interest is a very small figure. So definitely it is less than 9.5% per annum. So technically it should be totally exempt. However, there is one more provision which I am saying, that if employee contribution in the entire year for his RPF, NPS, superannuation fund total is exceeding 2,50,000. Now understand, the limit of 7,50,000 which is given for employer, the limit of 7,50,000 which is given for employer, it is combinedly for three things: RPF, NPS, superannuation fund. But the limit of 2,50,000 which is given for employee, it is for two things: RPF and PPF. If employee has contributed more than 2,50,000 in a year combinedly in RPF and PPF, whatever is the excess contribution, that is to investment, but whatever is the interest on that excess contribution, that will be taxable. Now here identify how much excess contribution employee has done. Employee has contributed 3,04,920. What is the excess contribution over and above 250? That is 54,920. Whatever will be the interest on that 54,920, that will be taxable. But now the question arises, sir, the total interest on my contribution plus employer contribution 49,325. The contribution on which interest to be found is 54,920. How to identify that how much interest belong to this particular amount? So the formula yet they are they have not given. CBDT has not clarified any rule up to now. So we will use normal mathematics. What is the total contribution we have done in this RPF? My contribution plus employer contribution, 3,04,920 multiply by 2, that means 6,09,840 total contribution. Against 6,09,840 we have received interest of 49,325. Then how much interest will be belonging to the amount 54,920? That is the amount contributed in excess of 250 by employee. So 54,920, 49,325 divided by 6,09,840 into 54,920, that means interest which will be taxable on employee contribution is 4,442. So my gross salary will be 27,76,442 minus 50,000 standard deduction, 27,26,442 is the answer. 27,26,442, the answer has to be A. So mind well, employer contribution over and above 7,50,000, then interest will be taxable along with that excess contribution. Employee contribution more than 2,50,000 in RPF plus PPF, then whatever over and above contribution has been done, even interest of that will also be taxable. See, we have also uploaded a video of May 2022 RTP. In that they have given the question of employer contribution. Here they are giving the question of employee contribution. For your exam, both the things are equally important. That employer contribution wala formula, this employee contribution also. So I am also recommending you to see the video of May 22 RTP after watching this entire video, because that RTP was really awesome. And this RTP is much more than what that RTP was. Okay. Now, the very next question. Okay. Let me tell you first of all one provision before we move to this MCQ. There is one section given in PGBP. Section 40 clause A subclause 5 read with 10 clause 10 CC. If let's say employer is giving some perquisite to the employee. So let's say here employer A Limited, here an employee Mr. A Limited is giving some perquisite to his employee. Let's say Mr. A, normal salary is rupees 10 lakh. The value of perquisite is rupees 2 lakh. So total income is happening 12 lakh rupees. Now whatever is the expenditure on this perquisite, A Limited will get as a expense deduction in PGBP, and whatever is the perquisite, it will be taxable to Mr. A, that we have already done. So total income is coming to 12 lakh. Let us find out the tax payable on this 12 lakh. So as per the normal slab rate, 2 lakh into 30% plus 1,12,500 basic tax plus 4% cess, 1,79,400. Now tell me, what is the average rate of income tax that this person paid? Average rate of income tax means total tax divided by total income. So 179400 divided by 12 lakhs. So average rate of income tax will come to certain 14.95%. Okay. Now all this happened. Mr. A said, I have one doubt. This company, you paid me perquisite of rupees 2 lakh, but don't you think so far that I have to pay the tax? I don't want to pay tax on that. Either you keep perquisite with you or you only bear the tax expense. Company said, okay, I will bear the tax expense. Tell me, how much tax you paid due to this 2 lakh rupees? So, what I will say, on 12 lakh rupees of total income, my tax was 179400, which is effectively 14.95%. So, on 2 lakh rupees, as per 14.95%, the tax will be 29,900, proportionate tax. So 29,900 is the tax. A Limited said, okay, granted. A Limited paid 29,900 rupees of tax to Mr. A. Now, if the tax on non-monetary perquisite is given by the company to the employee, that tax amount which is given, it is not allowed as a deduction for this company. It is disallowed as per 40 clause A subclause 5. And similarly, for the person who is receiving this tax amount, 29,900, the employee, this tax amount will be exempt under section 10 clause 10 CC. This you understood? Acha, and whatever is the final tax payable of employee, don't you think so employer has to deduct TDS under section 192? TDS under section 192, how it works? Whatever is the tax payable of employee, that employer will calculate and it will deduct the TDS up to that much amount. And if employee has said to employer that I will follow 115 BAC optional tax system, employer will also calculate the total income as per 115 BAC, tax payable as per 115 BAC, TDS will be deducted as per 115 BAC. Now, let us start reading this question. Mrs. Kajal, the general manager of Messrs Gold Limited, was paid a salary 4,50,000 per month, and the above salary includes non-monetary perquisite 50,000 per month. Means what is the total salary? See, perquisite is taxable, na? So what is the total salary? 4,50,000 into 12 month. That will be coming to 54 lakh. But in this 54 lakh, 50,000 per month is non-monetary perquisite. That means total 6 lakh rupees is also included as non-monetary perquisite. As per the terms of employment, the tax on non-monetary perquisite is to be borne by the company. So whatever 6 lakh rupees of perquisite has been given, and whatever will be the tax amount of that employer will not collect from the employee as TDS, rather employer will pay from his pocket, which won't be allowed as a deduction, but that is a separate story. At least employer will not collect that much tax from the employee. Now Mrs. Kajal contributed in PPF 1,50,000. What would be the amount of TDS to be deducted from the salary? Under which section? 192. If she intimated to the company that she want to opt for 115 BAC, so here the employer will calculate total income and tax payable as per section 115 BAC only. Okay. Now while we are applying section 115 BAC, remember, I cannot get any standard deduction or any kind of deduction under section 16 from salary income. So over here the salary 54 lakh, I will get no standard deduction. My income from salary will become 54 lakh. Now contribution of PPF generally allowed as a deduction in 80C, but if I am following 115 BAC, the entire chapter 6A, 80C to 80U cannot be deducted except two sections, 80 CCD subsection 2, 80 JJAA. So here I will not get any kind of deduction for this PPF amount of 1,50,000. So I have to compute, being an employer, that what is the total tax payable of employee. So first of all, total income is 54 lakh. On that I have to apply slab rate as per 115 BAC up to 250, 250 to 5 lakh 5%, 5 lakh to 7.5 lakh 10%, 7.5 lakh till 10 lakh 15%, 10 lakh to 12 lakh 50,000 20%, 12 lakh 50,000 till 15 lakh 25%, above 15 lakh 30%. So if I will calculate the slab rate according to that, my basic tax will come to 13,57,500. But don't you think so? My total income being an individual is more than 50 lakh up to 1 crore. 10% surcharge will also come into the picture. So I will add 10% surcharge. Whether marginal relief will come? The answer is no. Because see, the threshold is 50 lakh. The total income is 54 lakh. The difference is of 4 lakh rupees. So here generally up to 1 or 2 lakh we calculate marginal relief, not up to 4 lakh rupees of difference. So no marginal relief. On total tax I have to add 4% health and education cess. So my total tax will come to 15,52,980. Generally employer has to deduct this much TDS while paying the salary income by apportioning every month. However, one small problem. Employee has said that I will not pay tax on non-monetary perquisite. That employer, you have to pay from your pocket. Don't deduct from my salary. So here first of all we'll calculate that how much tax is to be apportioned to that 6 lakh rupees. So what simple we can do? 15,52,980 is the total tax on the total income 54 lakh, and perquisite is rupees 6 lakh per annum. Then what will be tax of rupees 6 lakh? So first find out average income tax rate. 15,52,980 divided by total income of 54 lakh. So average income tax rate will be 28.7589%. Perquisite that I am getting per year is 6 lakh rupees. So applying the average tax rate, the tax on non-monetary perquisite will become 172,553. This much tax employer will not deduct from the salary of employee. This much tax he will pay from his own pocket. And that's why now what will be the final tax payable of employee? 15,52,980 minus 172,553. So the TDS to be deducted is 13,80,427. And the balance rupees 172,553 he will pay from his pocket. So here the answer of TDS to be deducted 13,80,427. 427, the answer has to be A. Are you understanding this, people? Yes or no? 8 MCQs, but master blaster MCQs they have made. Okay. Now these notes don't work because now everything will discuss from this RTP itself. Mr. Dhanush, an Indian citizen, aged 35 years, worked in ABC Limited in Mumbai. He got a job offer from XYZ Inc. USA on 1st June 20. See, he got an offer in the year 2021. He left India for the first time on 31st July 20. That is again he left India in last year, that is 2021. Joined XYZ Inc. on 8th August 20, that is the last year. Now during the year 21-22, he visited India from 25th May 21 to 22nd September 21. So according to this much information, you came to know that we have to find what? Residential status. He has received the following income for the year 21-22. I am just reading each and every income. Along with that, we'll decide that whether this income belongs to India or outside India, right? Simply, India or outside India. Salary from XYZ Inc. USA. Obviously, this belongs to outside India. Dividend from Indian company. This is a Indian income. Agricultural income from land situated in Punjab. Arey, this is to exempt income. We don't have to count itself. Rent received or receivable from house property in Lucknow. Lucknow, that means this is a Indian income. Profit from a profession in USA which was set up in India. Received there. If any business or profession is set up in India, see, taxable or not is a different story. Let us keep scope of income aside. But this is actually Indian income. So this is Indian income. Fine. Determine the residential status of Dhanush and compute his total income. Now, understand, for any person who is an Indian citizen, who is visiting India during the year, Indian citizen or person of Indian origin, visiting India during the year, can I say he is visiting India during the year 21-22 because he left last year and he is an Indian citizen? He is covered under the third exception given by section 6 subsection 1, third exception, which says that first of all you have to check the condition of 182 days, that whether he is presented in India for 182 days. Now let us check over here. 25th May 21 till 22nd September 21. Both the days to be included in India. So in the May 31 minus 24, that is in the May month 7 days plus June plus July plus August plus September 22 days. Total he is in India for 121 days. Okay. So for a person who is Indian citizen or person of Indian origin while he is in visit on India, first we have to check 182 days. Here 182 days condition not satisfied. If it is not satisfied, then what we have to check? What is his Indian income? Whether that Indian income is more than 15 lakh or not more than 15 lakh. If the Indian income will be more than 15 lakh rupees, we'll check one more condition. 120 days plus 365 days in 4 preceding years. And then directly RBNOR. But if Indian income is less than or equal to 15 lakh, if it is not more than 15 lakh, then the person will be non-resident. See, once again, what we have to check? First 182 days. If satisfied, resident. If not satisfied, check what is the Indian income. That is total income excluding global income. Total income excluding income earned outside India. So his Indian income, if it is more than 15 lakh, we will check one more condition, 120 plus 365. And if not satisfied, then directly non-resident. Over here, not satisfying 182 days. So we have to check Indian income, and that's why I bifurcated outside India or Indian income. If you see what is the total Indian income, 5,50,000 plus 4 lakh. But see, don't see this 4 lakh rupees. Because this 4 lakh rupees is the rent received. From the rental income, 30% standard deduction is there. Na? So the income will be 2,80,000 plus dividend income 5,50,000 plus PGBP income rupees 6 lakh. Totaling to 14,30,000. 14,30,000. Can I say less than 15 lakh? And if it is less than 15 lakh, I don't have to check 120 plus 365 days. The person will be directly non-resident. See how the brilliant question they have drafted. If you forgot to deduct 30% standard deduction from this 4 lakh, your calculative Indian income will be more than 15 lakh. Your answer will change. This 30% matters a lot over here. Acha, why we have taken this 6 lakh rupees in Indian income? Because that section itself says that if any income is controlled from India, that will be counted as Indian income for calculating this 15 lakh rupees of limit. And that's why over here the person is a non-resident. What I said, the person is a non-resident because the Indian income is 14 lakh 30,000. So we don't have to check 120 plus 365 days. That's why the person will become non-resident. Now we have to solve this question based on the fact that the person is a non-resident, and we will identify whether any particular income will be taxable as a non-resident or not as per scope of income. Salary earned outside India, received outside India. Can I say it is not taxable to a non-resident? So this is not taxable. Dividend from Indian company, section 9. If any income belongs to India, that will be always taxable in India. Dividend from Indian company, that will be taxable to a non-resident, 5,50,000 taxable. Agricultural income from land situated in Punjab, section 10 clause 1. Agricultural income from India is totally exempt. Rent received or receivable from house property in Lucknow, again income from India, taxable to non-resident also after 30% standard deduction. And that's why taxability will be 2,80,000. Profit from a profession in USA set up in India, received there. Set up in India means controlled from India. Now understand, in the table of scope of income, the fifth income, profit or gain from business or profession accrued outside India, received outside India, controlled from India. Now that income is taxable only to two categories, R&OR, RBNOR. That is not taxable to non-resident. Just because control is from India, it can never be taxable to non-resident. So here control is in India, rest everything is outside India, and hence this income will not be taxable to a non-resident. As a non-resident, the income, total income will be 550 plus 2,80,000. That means total 8,30,000 will be the total income. So even they have covered residential status, scope of income both in this question, but again a brilliant point of that Indian income calculations were there, which is not given in the module. Understanding this. Then 10th question, house property question is there. Not belonging to the inter module, what they have done is CA final ICI module. In that house property chapter, this question is there. They have directly picked up that question itself with some little modification. CA final level question, provisions are all same. Mr. Roy owns a house in Kolkata. During the previous year 21-22, 3/4 portion of the house was self-occupied and 1/4 portion was let out for a residential purpose at a rent of 12,000 per month. First of all, for any house property, if part of the house is SOP, part of the house is LOP, you have to calculate proportionately. Here 3/4 of the house property is SOP and 1/4 of the house property is LOP. Now we all know that first we have to do calculation of SOP. Net annual value of SOP will be always 0. What we will deduct? Interest. Interest on borrowed capital. Whenever it will come, we'll find out and we'll deduct. But if the property is let out property, first we need to see what is expected rent. Then we need to see what is actual rent. Whichever is higher will become my gross annual value. From gross annual value, municipal tax will be deducted. I will get net annual value. From that 24 clause A, 30% of NAV. From that interest on borrowed capital I have to reduce. Then I will get the income of LOP. Okay. Let us read the question. The 1/4 portion is let out for a rent of 12,000 per month. Tenant vacated the property on 20th February 22. So the property was vacant in the month March 22. So can I say 1 month vacancy loss concept is there. Now rent for the month of January and February could not be realized in spite of owner's effort. And all the condition of rule 4 are satisfied, that is unrealized rent. And as per the normal assumption, we have two alternatives. As per the first alternative, which we will always follow in the exam, unrealized rent to be deducted from actual rent, not from GAV, from actual rent. Whereas the second alternative is we will deduct from final GAV. But generally ICA follows the first view in the main answer and then it write a note as per alternative. So we will always follow the first view wherein we will deduct unrealized rent from actual rent. So over here, can I say 1 month vacancy loss? So total 11 month rent is accrued. From that 2 month unrealized rent. So finally I will get the rent of 9 month. So what will be my actual rent? 12,000 into 9. If I do 12,000 into 9, my actual rent will come to 1,08,000. Then let me write over here 1,08,000. Acha, don't do 3/4, 1/4. This belongs to let out portion only. See, now the information which they have given is related to the entire house. The municipal value of the property 4,50,000 per annum. Fair rent 4,70,000 per annum. Standard rent 5 lakh. Now what I will get based on this three information? I will get my expected rent of the entire property. Municipal value or fair rent, whichever is higher, that amount, or standard rent, whichever is lower, that is the expected rent. 450 or 470, whichever is higher, 470. That amount or 5 lakh, whichever is lower, 4,70,000. But this is of the entire house. I need expected rent only for the let out property, and my let out property contains only 1/4 portion. So 4,70,000 divided by 4, that means what is expected rent for this LOP? 1,17,500. Okay. Now let us decide GAV also. I cannot do simply whichever is higher. No. Because in this case vacancy loss concept is also there. So what I have to check? Why my actual rent is less than expected rent? It is because of vacancy or any other reason? If my actual rent is less than expected rent just because of vacancy, I will not do whichever is higher. My actual rent will become GAV. How to find out that? See, think, what if that 1 month rent, which is vacated month, what if that 1 month rent is realized? Then what would have become your actual rent? If that 1 month rent is realized, I would have got more 12,000 rupees. So in that case, my actual rent will become 1,08,000 plus 12,000, that is 1,20,000. Don't you think so? If that vacancy was not there, my rent would have been 1,20,000, which was higher than expected rent. But as of now, it is less than expected rent. So my actual rent is less than expected rent just because of vacancy. And that's why over here I will not do whichever is higher. My GAV will become actual rent, that will be 1,08,000. Are you understanding this? He paid municipal taxes 10% of municipal value, 450. So for the entire house, 10% municipal tax will be 45,000. In SOP, so I don't deduct municipal tax. I deduct only in LOP, which is 1/4 of the entire house, which will become 11,250. So what will be my net annual value over here? 96,750. 96,750, I will deduct 30% standard deduction. So 96,750 into 30%, that means standard deduction 29025 I have to deduct. Further they said, a loan of 30 lakh was taken by him during the year 2012 for acquiring the property, and interest paid in the current year is 1,51,000. Now see, interest I have to bifurcate. 3/4 portion I will divide in SOP, 1/4 in LOP. So 1,51,000 into 3 divided by 4. What is the interest for SOP? 1,13,250. However, what will be for LOP? 151 divided by 4, that will be 37,750. So ultimately, what will be the loss of LOP? What will be the income of LOP? 96,750 minus 30% minus this interest. So 29975. This is the LOP income. 29975. This is the LOP income, and in SOP I have a loss 1,13,250. If I set off this, I will get ultimate loss. I will get ultimate loss 83,275. This is the ultimate loss 83,275. 83,275, there is a loss. Are you understanding this, people? Yes or no? So just divide and think properly. This is also one of the very good question in which you see the bifurcation, unrealized rent, loss due to vacancy, everything is covered. So it was a good question. Moving to the 11th question. Before we move to this question, let me just remind you certain provision. There is a section 43 CA read with section 50 C for seller of land or building, and for purchaser we have a section 56 subsection 2 clause 10 which we just saw in the first MCQ. Fine. Now understand what this both section says for the seller, that if the stamp duty value generally on the date of registration, but if on the date of agreement part consideration received by banking method, then stamp duty of the date of agreement. If the stamp duty value is more than 110% of actual value, then the stamp duty value will become sale value, that is the full value of consideration. If you are a constructor, you are a developer, you are a builder, to sell land and building is a PGBP income. So this provision will be given in 43 CA. But for a normal person for whom land or building is a capital asset, the same provision is applicable in section 50 C. Just the section is different because the head is different. Achha, similarly for purchaser, if he purchased land or building at a price less than stamp duty value, whatever is the difference, it will be taxable to the buyer also. However, it will be taxable if it is exceeding number 1 50,000 and number 2 it is exceeding 10% of actual value, then it will be taxable to the buyer. Fine. Now understand, due to COVID situation, they have introduced one exemption through a circular. Now over here you are studying it for the last time, but it may be possible that in the last attempt of this provision they may ask you this. If, see, this what I am gonna say is only applicable if you are a builder. That means the amendment which has came, temporary amendment, was in section 43 CA, not in section 50 C. If you are a builder and you are transferring any land or building in between 12th November 20 till 30th June 21, what date I am saying, 12th November 20 till 30th June 21, and you are transferring a residential house property like a first time allotment. While first time allotment means after constructing the same, first time you are selling to someone. 12th November 20 to 30th June 21, first time allotment, residential house property, sale consideration less than 2 crore. Then instead of 110%, the provision will be applicable as if it is 120%. And at that time for purchaser also, instead of comparing with 10% of actual value, will compare with 20% of actual value. However, if the registration date, that is the transfer date, is outside this particular dates, then again 110% will continue, not 120%. So see, again I am saying this is a temporary amendment. It was applicable only up to 30th June 21. Whatever transfer was made up to 30th June 21, it was applicable in that only. For a constructor, 43 CA is there and only in that section amendment has came. If the transfer, that is the date of registration, is in between 12th November 20 to 30th June 21, for the first time allotment of residential house property, the sale consideration is less than 2 crore, instead of 110%, will compare stamp duty with 120% of actual value. And similarly for purchaser, the difference will be compared with 20% of actual value instead of 10% of actual value. However, if transferring the same is a capital asset, then always 110% because there is no amendment. Now, Mr. Ramesh is a property dealer. Can I say to sell the property is a PGBP income? And for Mr. Ramesh, 50C will not apply, 43CA will apply. Has developed an independent floor of 4 residential unit. He sold one of its residential unit to Mr. Vikas, who is a dealer in spare parts. Means for Mr. Vikas, this is not purchase of inventory, this is purchase of a capital asset. For rupees 55 lakh. On 1st June 21. The agreement was however entered on 1st April 21. Mr. Ramesh had received a down payment of 5 lakh by account pay check from Mr. Vikas on the date of agreement. So tell me, the stamp duty comparison will be on the date of registration or date of agreement? On the date of agreement. See, here they have given the stamp duty value 1st April 21, 1st June 21, 1st December 21. Let us keep this portion pending. Let us first decide the transaction of Ramesh and Vikas. Ramesh, Vikas. Ramesh transferred a house property to Mr. Vikas. For Ramesh, it is a PGBP income. At 55 lakh rupees they transferred. However, the stamp duty value which we have to compare is on the date of agreement, because the part consideration was received by account paycheck. So the stamp duty value was 65 lakh. Stamp duty value 65 lakh. The question arises, for Mr. Ramesh, what will be the sale value as per 43 CA? Let me tell you, the registration has been done on 1st June 21. 1st June 21, that is up to 30th June 21. So can I say over here, we will not apply the rule of 110%, we will apply the rule of 120%. Let us check what is 120% of actual value. 55 lakh into 120%, that will become 66 lakh. Whether my stamp duty value is more than 66 lakh? No. So over here, stamp duty value I have to ignore, and the actual value 55 lakh will become the sale value for Mr. Ramesh, because 120% is to be compared. Similarly for purchaser, what is the difference? What is the discount? 10 lakh rupees, because stamp duty value 65 lakh, he has purchased for 55 lakh, difference is 10 lakh. This difference should exceed by two things. Number one, 50,000 exceeding. Number two, 20% of actual value, because for the seller we will applying 20%, so for purchaser also 20%. 20% of actual value, 55 lakh into 20%, that will become 11 lakh. Whether the difference 10 lakh is more than 11 lakh? No. So for the buyer, nothing will be taxable in IFOS. Nothing will be taxable under 56 subsection 2 clause 10. Are you understanding this first point? See, for Mr. Ramesh, 120% rule. So whatever transfer he is doing to Mr. Vikas, 55 lakh rupees will be the sale consideration. Similarly, think about Mr. Vikas. For him also we'll see 20% of actual value. For him nothing will be taxable, as it is not exceeding 50,000, not exceeding 20% of actual value. Now let us read that pending paragraph. Mr. Ramesh sold remaining 3 flats to Mr. Raj, Mr. Ashok, Mr. Ashish for 60 lakh each on 1st December 21. All the units were transferred by way of first time allotment. Okay. 1st December 21, the units were transferred, and let us assume that they must have done agreement also on 1st December 21, because nothing has been said regarding what is the date of agreement and all that stuff. So obviously over here, the actual consideration which is given in the question is 60 lakh, and the stamp duty value which we have to compare is 70 lakh. For the seller, obviously 43 CA will be applicable, and for the purchaser 56 subsection 2 clause 10 will apply. But here we don't have to see 120%, we have to see original 110% rule, because the transfer has been taken place on 1st December 21, which is after 30th June 21. So now again we have to come back to 110%. Here for the seller, whether stamp duty value is more than 110% of actual value, so 60 lakh plus 10% will become 66 lakh. Stamp duty value is more than that. For the seller, the sale value of every flat will be 70 lakh over here. Yes, 70 lakh, the higher value will be considered. And he has sold 3 flats, so total 210 lakh. Similarly, for the purchaser, they have received the discount of rupees 10 lakh. It should exceed by two things. Number one, it should exceed 50,000. It is exceeding 50,000. Number two, it should also exceed 10% of actual value. Actual value in this case is 60 lakh. 10% is 6 lakh. The difference is exceeding 6 lakh. For all the 3 buyers, 10 lakh rupees will be considered as IFOS income. For all the buyer, 10 lakh will be taxable in IFOS. Are you getting my point, people? Yes or no? So a good question again. Okay, question number 12. A normal set of carry forward chapter question is there. Mr. Kabir, a resident individual aged 45 years, furnishes you the following particulars of his income and other details. Number one, income from tea business. Let me remind you, in case of a tea business, it is a composite income. 60% agriculture and 40% is business income. Okay, so from this 5 lakh, only 40% is taxable, remaining is exempt. 2 lakh rupees will be considered. Losses from sugar business. So this we have a loss of 4 lakh. Dividend from Indian company carrying on agricultural operations. See, what company is doing, I don't care. For me, dividend is always taxable as a shareholder under IFOS. Agricultural income 55,000. This is so completely exempt. Salary received as a partner from a partnership firm, which is allowed as a deduction to the firm. Section 28 clearly says for a partner, whatever salary interest he is receiving from the firm, it will be deemed PGBP income. So even this is PGBP income. Net annual value of the house property 4,20,000. So what will be house property income after deducting 30%? 2,94,000. Loss from gambling 1 lakh. Can I say whatever is the loss from casual income, gambling, betting, etc. If there is any loss, we have to completely ignore them. We can't set off, we can't carry forward. Short term capital gain 75,000. Below that, loss on sale of shares listed in BSC, it were held for 15 months. So can I say this will be long term capital loss of 3 lakh? Long term capital loss, because for listed share period of holding is 12 months, and here I am transferring this in after 12 months. So obviously this will be what? Long term capital loss. And let me remind you, we cannot set off long term capital loss against short term capital gain. We can set off short term capital loss against short term capital gain, that is possible. We can set off short term capital loss against long term capital gain, that is also possible. Long term capital loss cannot be deducted from short term capital gain. Fine. Life insurance premium paid 10% of sum assured, so 80,000 will be allowed as ATC. Bank interest on fixed deposit, this is what? IFOS income. Interest on saving account, this is also IFOS income. However, this person is aged what years? 45 years, not a resident senior citizen. So whatever is the saving bank account interest, it will be allowed as a deduction in ATTTA up to rupees 10,000. You must be forgetting in the exam. Some other brought forward losses are there. Losses belonging to last year. Business loss 1 lakh, short term capital loss 45,000, house property loss 3 lakh, maintenance of race horses loss 60,000. And we have to compute total income assuming that he is not following 115 BAC. Okay, all the good points from this chapter they have covered in one question, so it's good. Now, first of all, let us compute everything about PGBP income. Let us find out what is the total PGBP income is there in the question. 2 lakh rupees tea business. Then 4,50,000 salary as a partner. Total 6,50,000. From that I have a current year loss of rupees 4 lakh that I will set off. So the remaining value will be 2,50,000. Against this 2,50,000 I have a brought forward loss of sugar business rupees 1 lakh. So I will set off that 1 lakh rupees also. My final PGBP income will become 1,50,000. Final PGBP income will become 1,50,000. So everything about PGBP income we have done. This is done. This is also done. And this is also done. Now IFOS income I have 1 lakh rupees dividend. 55,000 rupees is bank FD and 13,000 saving bank account. So 1 lakh plus 55,000 plus 13,000. Total IFOS income I have over here 1,68,000, and I can't see any loss which I can set off as of now. So 1,68,000 will be deemed IFOS income. We are keeping it pending, and we just saw 10,000 ATTTA deduction, that is also there. Now house property income is there. After 30% standard deduction 2,94,000. But we have last year ka house property loss. Last year ka house property loss can be set off in this year without any monetary limit of 2 lakh, because that 2 lakh rupees limit is applicable for setting off against inter-head, not intra-head. So I can set off full house property loss. But see, over here 3 lakh rupees of loss is there. My income is 2,94,000. It will become 0. Remaining 6,000 will still be carry forwarded. So house property will be 0 and remaining will be still carry forwarded. So this is also done. Short term capital gain 75,000. I cannot set off long term loss, but I have carry forwarded short term capital loss 45,000. So I will set off 45,000 against 75,000, and 40,000 will be short term capital gain. Sorry, 30,000 will be short term capital gain. So my total gross total income will be 3,48,000. Then I have life insurance premium 80,000, which is allowed as ATC. That I will deduct. Total income will be 2,58,000. Are you understanding this, people? Yes or no? So it was a good question. But the question which we are going to do now is the best. If you see PGBP module of CA final, in that this question is given. So they have picked up first of all this question from PGBP chapter of CA final. Obviously all the provision are there in Inter CA also. But whatever is there in CA final module, they have upgraded that question. They have increased the level of that question and then they have put in this RTP. So it's going to be interesting. However, while drafting the answer of this question, a very small mistake has been done by ICAI, which will be corrected very soon. Like in May 22 RTP also, there was a query, there was a small mistake which I have discussed in the video, and later on the mistake was rectified by ICAI as a separate notification, which I have also mentioned in the comment section of that video. Similarly, in this RTP also there is a small mistake which will be rectified by ICAI. It's just a clerical error. Mr. Kamal, having business of manufacturing of consumer items and other product, gives the following trading and profit and loss account. So basically trading profit loss account is given. Below that all the adjustment is given. After all the adjustment, one single line is written. Compute the total income and tax liability of Mr. Kamal for previous, that is assessment year 22-23, in the most beneficial manner. This line is very dangerous. Most beneficial manner means you have to compute tax liability as per normal provision also, as per 115 BAC also. Both the things are applicable. Fine. First of all, we have a rule always of following regular tax system, obviously for finding regular total income. Whenever this kind of question is there, I have told you the very first head of income will be PGBP, and PGBP will always start with net profit as per P&L 50,85,000. Then how to read the question? I have said reverse U. First read credit side, give effect of that, then all the adjustment and then debit side. First of all, my answer will start with net profit as per P&L 50,85,000. Now let us go to the credit side. Whatever is not belonging to business will deduct the same. Sales belonging to business, but see the turnover is more than 2 crore. That means I cannot follow presumptive taxation. Because if it is up to 2 crore, I can directly show 8% or 6% under 44 AD. Over here, turnover is more than 2 crore. Closing stock is given 6,75,000. We have to keep in business only. Income tax refund 30,000. Whether income tax refund is PGBP income? First of all, income tax refund is never taxable. Interest on income tax refund is taxable under IFOS. However, nothing is taxable under PGBP. So 30,000 is included in PGBP income. I have to reduce the same, 30,000 deducted. Then warehousing charges 22,50,000. Warehousing charges. Have you ever heard the words warehouse? Section 35 AD specified business where you are getting 100% deduction of capital expense and revenue expense. Warehousing of sugar, warehousing of agricultural produce, hotel, hospital, infrastructure facility, cold chain facility, many businesses are there which are covered under 35 AD. Warehousing charges, for that many adjustment will be there, but by reading this it seems that it is belonging to section 35 AD. And if it actually belongs to 35 AD, we have to separate the same. We have to separate other business and 35 AD business. Let us keep it pending as of now. It all depends on adjustment. The first adjustment, income tax refund which you already deducted, include 4570 interest. See, we deducted from PGBP, so nothing to be done in PGBP. But don't you think so? Interest on income tax refund is IFOS income. So under the head IFOS, I have to add 4570 as an income. So 4570 will be added as an income under IFOS. Then bonus to staff include the amount of 7,500 paid in the month of December 21. Okay. We have a section called 43B. Some of the expenditure is allowed as a deduction only if it is paid up to the due date of filing return of income under section 139 subsection 1, that is original return due date. And if you file your return after that due date, that expense will be disallowed, but it will be allowed in the year in which it is paid. So if you pay the expense up to the due date, very good. If you don't pay up to the due date, it will be disallowed. Bonus and commission is one of them. Now over here what they have written, 7,500 rupees of bonus were there for the year 2021, which you paid in the month of December 21. Now what is the due date? Even for the audited person, what is the due date to file the return? 31st October. For the year 2021, the return filing due date would have been 31st October 21. But you paid the bonus on December 21, can I say after the due date of 139(1)? Means in the year 2021, by applying the provision of 43B, 7500 must would have been disallowed. It would have been disallowed, yes. But in which year it will be allowed? In the year in which it is paid. In which year it is paid? 21-22. So can I say I have to deduct 7500 in this year because it was disallowed in last year? However, I will not deduct separately because already this is included. This is included already in the bonus expense. It is already there. And if it is already there, my profit has already been reduced. Means I have already given the effect, which is a correct effect. I don't have to do anything. But just I have to write a note that why this expense I have not added back though it belongs to last year, because as per 43B this expense was disallowed last year, which is allowed in the year of payment. As it is already debited to P&L, we don't have to do any other adjustment, we have to keep it as it is. Then advertisement expense include an amount of 2500 paid for advertisement published in souvenir issued by a political party. This payment made by way of account pay check. Whatever advertisement expense you have done which is given to a political party, that expense is to be disallowed as per 37 clause 2B. Any advertisement expense paid to political party disallowed. However, whatever expense you have disallowed because you have paid to political party, that is allowed as a deduction under section 80 GGC because this person is an individual. 80 GGC. Only if it is not paid in cash. This is not paid in cash. So first what I have to do, 2500 I will add back while computing PGBP income. 2500 I will add back. But then under 80 GGC I have to deduct na. ICAI has done a small error. ICAI has not deducted 2500 over here. That is the clerical error. This has to be deducted. In the CA final module also they have deducted this. Here they have forgot to deduct. They will do the same. Then, but as of now, I will not amend all the answers because our all answers will change. You assume that we have deducted 2500. We have to deduct. You assume that we have deducted. And so on will tally the answer. Otherwise, every figures will change. Then, miscellaneous expense include amount of 15,000 paid toward penalty for non-fulfillment of delivery condition of a contract of sale. Penalty. Explanation 1 of section 37 subsection 1 says that any penalty, late fee, fine which is offence under any law, that is to be disallowed. This is a penalty 15,000. Can I say it is to be disallowed? Never. If it is a penalty as per any law, then it is to be disallowed. This is not penalty as per the law, it is as per the business contract, which is a normal expenditure. I don't have to disallow. If this would have been because of any law, I would have disallowed. This is because of a normal business contract. I don't have to disallow. So keep it as it is. It is truly debited in the P&L. I don't have to do anything else. Amount of rupees 1 lakh paid to political party by check. See, again donation to political party. Again to be disallowed. Donation expense never allowed as a deduction. So 1 lakh rupees is to be disallowed. I will get deduction of 80 GGC. 1 lakh rupees. This 1 lakh rupees they have taken as a deduction. But they have forgot that 2500. Let us assume over here they have deducted 1,02,500. Then goods and service tax demand paid, which is debited in the P&L. Goods and service tax demand paid. It includes 5,300 charges as a penalty for delaying filing return and 12,750 toward interest. Now see, I always teach in the classroom that whatever is the penalty for late filing GST, it is to be disallowed as per explanation 1 of 37(1). Penalty as per the offence under any law. So this penalty of 5,300 is to be disallowed. However, if there is any interest on late payment of GST, that interest is allowed as a deduction. Supreme Court judgment in the case of CIT versus Dalmia Company. Interest on late filing GST is allowed because interest is an extension of tax. It is not penalty. You don't remember judgment. It is not there in the syllabus of yours. It is there in CA final. You remember the conclusion. Late fee, penalty, fine, disallow. Interest allowed. So over here 5,300 only will be disallowed. Interest will be allowed as it is already debited to P&L. I don't have to do anything else. But 5,300 I have to add back. Now, Mr. Kamal had purchased a warehouse building 20 lakh in rural area for the purpose of storage of agricultural produce. Means this warehousing charges what I have received is for warehousing of agriculture. Can I say it is a specified business under 35 AD? So from my normal business income, first I will deduct this 22 lakh 50,000. I will deduct this 22 lakh 50,000. And I will add a separate another PGBP income point in which I will add 22 lakh 50,000 as an income. Why I am segregating this? Because against this I will get deduction of 35 AD. See what he has done? He has purchased a building of rupees 20 lakh. This was made available for the use from 15th July and above income is credited in the P&L which we already segregated. However, on this 20 lakh will not get depreciation, will get 100% deduction. If any capital expenditure done for the specified business, it is allowed as 100% deduction except land expense. Here it is no land expense. 20 lakh is a building expense. I will get 35 AD deduction. So my PGBP income from this business will be 2 lakh 50,000. Knock knock. 1 point. If you are claiming any of the deduction of 10 AA, 35 AD, 80 QQB, 80 RRB, 80 JJAA, and in the same question if tax payable is also there, you have to apply one concept called alternate minimum tax, AMT. Here I have claimed 35 AD. They have also asked me to compute tax payable at the end. Means apart from regular provision, in the regular provision I also have to find out alternate minimum tax. And here too I have to compute the income as per 115 BAC also. So all the three things are there. Okay. Just for your knowledge, we'll do it. Depreciation under books work out. Depreciation as per the act work out 65,000. Acha, what is the depreciation that is debited to P&L? 1,07,250. That is to obviously to be disallowed. And whatever is the depreciation as per income tax act, that is to be deducted, and that is what? 65,000 rupees. That I will deduct over here. Then interest on loan include 80,000 paid to Mr. X, a resident, on which tax was not deducted. As per section 40 clause A, any expenditure paid to a resident person against whom you were supposed to deduct TDS but you didn't deduct TDS, then 30% expense will be disallowed. And if the person was a non-resident, then 100% disallowed. Here the expense I have paid to a resident person, 80,000 interest I have paid, more than 5,000, 194A TDS section is applicable. I have to deduct TDS, I have not deducted TDS. Person is a resident, so 30%, that is 80,000 into 30%, 24,000 will be disallowed. So here 24,000 disallowed, 65,000 deducted. PGBP income, total PGBP income, IFOS income, 80 GGC, assume it is correct. Total income 31,33,620. This is my normal total income 31,33,620. Compute the tax payable on 31,33,620. Normal tax payable. Forget about everything. Normal tax payable. So 21,33,620 into 30% plus 1,12,500 plus 4% says 7,82,690. 782,690. However, don't you think so? This is not my final answer. Because in the same question I have claimed a deduction of 35 AD. I am supposed to see what is my adjusted total income. And if my adjusted total income is more than 20 lakh, alternate minimum tax concept is applicable. Now here, my normal total income is more than 20 lakh. So obviously adjusted total income is more than 20 lakh, and that's why alternate minimum tax concept is applicable. Now what we need to do while we are calculating alternate minimum tax? First of all, find out total income, that we already did, 31,33,620. Then we are supposed to see what is my tax payable as per normal provision, 782,690. Number 3, find out adjusted total income. What is adjusted total income? What if I would have not taken those deductions, 10 AA, 35 AD, 80 QQB, 80 RRB, 80 JJAA? Then what would have been my total income? Can I say over here, if I will not take deduction of that 35 AD, which is a 20 lakh rupees expenditure on building. So in my total income, I have to add back 20 lakh rupees. 31, 33, 620. I have to add back 20 lakh rupees of 35 AD. But when I am adding it back, I obviously have to deduct notional depreciation. See, If I deduct capital expenditure, I can't get depreciation benefit. But if I don't deduct capital expense, I have to get notional depreciation expenditure as a deduction. So I am adding it back 20 lakh rupees. So at the rate of 10% depreciation on building, 2 lakh rupees I have to deduct. So my adjusted total income will become 49 lakh 33,620. Now on that I have to apply 18.5% tax plus 4% cess. So plus 18.5% plus 4%. That means my tax as per AMT will come to 949,228. So basically 230. 949,230. This is the tax as per AMT. Now what I have to pay ultimately? Whichever is higher. Normal tax or AMT, whichever is higher. So I have to pay 949,230. But it is not an extra burden, because whatever AMT I have paid over and above normal tax, that much I will get a credit for the future. So the credit available in the future is 166,540, which I can set off against the tax payable if in the future I anytime pay the tax as per normal provision. Fine. Now that was one part of this question, where I did the entire calculation, I solved the total income, I solved tax payable as per regular provision of income tax. But over here they have asked me to calculate tax in the best manner possible. So I also have to calculate total income as per 115 BAC. And when I am finding the income as per 115 BAC, the concept of AMT will not apply. I will not get deduction of 35 AD. I will not get the deduction of chapter 6A also. So if over here I have to compute my total income as per 115 BAC. So what I have to do? First of all, pick up the total income as per regular provision. 31, 33, 620. 35 AD add back. But normal depreciation I can always take. One more thing I have to add back is 80 GGC 1 lakh, because it is also not applicable if I am following 115 BAC. So now what will be my total income as per 115 BAC? My total income will become 50 lakh 33,620. 50 lakh 33,620. That will be my total income as per 115 BAC. Now I have to find tax payable as per 115 BAC. 250 slab, 5% rate up to 15 lakh, then onwards 30%. If I'll do that, my basic tax 1247,586. But don't you think so my total income is more than 50 lakh up to 1 crore? 10% surcharge will come. So on basic tax I will add 10% surcharge. So my tax will become 1372,345. Now if surcharge is coming into the picture, I have to think for a while whether there is any chance of coming marginal relief. And yes, in this question marginal relief will come, because my total income 50 lakh 33,000 is very nearer to the threshold 50 lakh. Marginal relief will come. So let us find out what will be marginal relief. Here while calculating marginal relief, we have to think everything as per 115 BAC. 50 lakh 33,620, on that after applying surcharge but before health and education cess, the tax is already what we found 1372,345. Now we have to think, what if I have exactly 50 lakh rupees of income, that is the threshold. What will be my tax before health and education cess as per 115 BAC? So as per 115 BAC, that will be, this much so will be same, 12,500 plus 25,000 plus 37,500 plus 50,000 plus 62,500. That means 1,87,500. And after 15 lakh up to 50 lakh, that is 35 lakh into 30%, that will be 10 lakh 50,000. So my basic tax before health and education says on 50 lakh as per 115 BAC, 12,37,500. Now think, how much my income has increased? 33,620. How much my tax has increased because of this? 1,34,845. How much tax has increased more than difference of income? The difference between these two? 1,01,225. This is marginal relief. So my marginal relief I have to deduct is what? 1,01,225. After deducting marginal relief, I have to add 4% cess and final tax payable to be round off 13,21,970. Can you imagine? In a single question, how many concepts they have tried to incorporate? Finally, they have asked me advice also. Which system to follow? Regular system or 115 BAC? Or obviously regular system. In that, after applying alternate minimum tax also, my tax is coming to, let's say, 9,49,000, and over here 115 BAC directly 13 lakh without any AMT credit. So I will follow normal tax payable. In that also I will get AMT credit for future purpose. Understanding this, question number 14. Again, a very unique concept they have tried to incorporate. State government of Madhya Pradesh grant a lease of coal mine to ABC Company Limited, an Indian company, on 1st October 21 and charged rupees 8 crore for the lease. ABC Company Limited sold the coal of rupees 2 crore to Mahapower Limited, another Indian company. During previous year 21-22, Mahapower furnishes a declaration to ABC Company Limited that the coal is to be utilized for the purpose of generation of power. The turnover of ABC Company Limited and Mahapower Limited both of the last year was 11 crore and 12 crore. What is the amount of tax required to be deducted or collected in respect of the above mentioned transactions, if any? Now understand, there is a company, ABC Company Limited, selling the coal to Mahapower Limited. Now at that time, when coal, lignite, ore kind of minerals are sold, basically TCS under 206C subsection 1 will come into the picture. However, there is a proviso to this section that any TCS given in that first subsection is not applicable if the purchaser is giving a declaration that he is gonna use this as a raw material to manufacture something or to manufacture the power, generating power. So here, TCS 206C clause 1, ABC Company Limited selling something to Mahapower, and Mahapower says don't collect my TCS because I'm gonna use this coal to generate the electricity, then it's fine. ABC Company will not collect TCS under 206C clause 1. This section will not be applicable. Fine. Think from the viewpoint of Mahapower Limited. The last year turnover of this company was more than 10 crore. During the current year, it is purchasing some goods from a seller and the worth of that goods is rupees 2 crore. That is more than 50 lakh. One TDS section come into the picture, 194Q, because it override 206C1H. 194Q says if you are a buyer whose last year turnover was more than 10 crore, in current year you are purchasing the goods from one of the seller more than 50 lakh, 0.1% will be the rate of TDS to be applicable. TDS to be deducted of the seller over and above 50 lakh. Over here Mahapower Limited will deduct TDS of ABC Company Limited on rupees 1 crore 5 lakh. 1 crore 50 lakh, that means over and above 50 lakh. 0.1%. So 1 crore 50 lakh into 0.5%. Basically the TDS will be deducted under 194Q and the TDS will be deducted of rupees 0.1%. That means 15,000 TDS to be deducted. 194Q. Are you getting this, people? Yes or no? Last. Mr. Vikas, a resident in India aged 80 years, is having a house property in Mumbai. He has let out the house property to ABC Limited for a rent of 50,000 per month from 1st April 21. Very important, by the way, this question. He does not have any other source of income. Is Mr. Vikas required to file his return of income? If yes, why? Whether to file return of income or not, it is said by section 139 subsection 1 along with some explanation. Plus in my statutory update video, I have covered some amendments which are applicable to your exam. Please see that video if you have not seen yet. They have drafted a question also on that. Rule 12 AB, which gives some more cases where return of income is to be filed. 139.1 is pretty clear that if your gross total income before claiming capital gain exemption of 54 etc. is more than basic exemption limit, you are supposed to file return of income. You have a foreign asset and you are R&R, file return of income. have done foreign tour expenditure more than 2 lakh, file return of income. Electricity expense in a year more than 1 lakh, file return of income. Deposited more than 1 crore, file return of income. Rule 12 AB has brought some more cases. Business turnover more than 60 lakh, file return of income. Gross receipt of profession more than 10 lakh, file return of income. Now very important, listen it carefully. TDS, TCS collected or deducted during the year more than 25,000, file return of income. But if you are a resident senior citizen, TDS, TCS more than 50,000 in a year, file return of income. Over here, what will be the gross total income of this person? 50,000 is the rental income per month. So in a year 6 lakh minus 30% standard deduction. So 4 lakh 20,000. Gross total income is 4 lakh 20,000, less than basic exemption limit. Because the person is 80 years, the basic exemption limit is 5 lakh. The income is less than basic exemption limit. So as per 139 subsection 1, not supposed to file return, yes or no? Yes. However, this rental income is paid by a company ABC Limited. And for a company, whenever rental expenditure is paid, 10% TDS is to be deducted if the annual rent is more than 2,40,000. Here the gross rent is 6 lakh, more than 240. Company must have deducted 10% TDS. That means company must have deducted 60,000 rupees of TDS. Assuming that lower TDS certificate was not granted, so 60,000 TDS has been deducted. As per Rule 12 AB, for any resident senior citizen, if TDS, TCS collected or deducted is more than 50,000, they are supposed to file return of income. Here TDS, TCS is more than 50,000, that is 60,000. Then this Mr. Vikas is supposed to file return of income. Return of income is to be filed compulsorily. Are you understanding this, people? Yes or no? And then to indirect tax will start. So over here 100% RTP November 2022 direct tax is covered with each and every provision which I could explain in the best manner. I will request you 3 things. If you have not watched up to now statutory update video for November 22, must see that. Second thing, for any concept, for any chapter, if you are not sure whether I recall this or not, but you want to revise it quickly, we have marathon lecture uploaded on the YouTube. You can see any of the chapter, the time slab is also given. And third, must see RTP video of May 2022. RTP video of May 2022, even that is also uploaded on the YouTube official channel of JKSC. After watching this video, also see May 22 RTP video. Many other concepts will also get clarified. So over here, our discussion for RTP is completed. All the best for your examination. Thank you so much.